Hi there, Ridgely Goldsboro here from Harding Shymanski, and I am delighted to welcome you to part one of our financial literacy series on earning, spending, and budgeting. I'm here with John Key, HSC Senior Executive Consultant, who will share valuable information with all of us. But John, before we jump in, April is Financial Literacy Month. So please share with us, what is financial literacy?
You know, Ridgely, there are a lot of definitions that are out there, but just to basically put it down in one simple sentence, it would be just understanding how to effectively use financial tools. And it's really building a relationship with money, and it's really a journey. And it's really no more complicated than that.
Well, let's dive into the questions.
Sure.
So first of all, how can we measure our earnings?
Earnings are measured in a net fashion. And what I mean by that is you have pre-tax, post-tax. So when you have a check and say you're making $1,000 a week gross, you're really only bringing home $650 a week. So what we want to do is we want to measure your income in a net fashion, what you actually bring home on your paycheck. So it's the net income that you bring in after all taxes and expenses are taken out of your payroll check.
Now, are there ways that we can, additional ways that is, that we can enhance our income?
Great question. There are a couple things you can do. Number one, when you elect at your employer to deduct, and we'll talk more about this in later versions and later topics, about your 401k contributions. Your 401k contributions are pre-tax deductions. So when you take $1 out and invest it in your 401k for your pension later on, it's really only costing you 65 cents. So you can maximize the actual total return of your payroll by using some of these tax advantages of 401k plans. Another way to do that is, a lot of people do this. You may have a side hustle. You may have some additional income you can make. And it could be quite simply taking on a part-time job on the side that you enjoy. Maybe you are just the desk clerk at the local gym. Maybe you do catering work and help someone that's catering, and you pick up, that sounds small, but you can pick up a $50, $100, $200 a week, just knocking around a little bit at night, that is true income to you that can supplement your net income.
Now, how do we determine our fixed expenses per month?
Fixed expenses really boil down to your housing, maybe your transportation. It's going to be utilities. It's going to be those items. It could be healthcare. It's going to be those items that every month, you know, you have a fixed expense at a certain amount that's going to come out of your net pay.
So then how do we determine our variable expenses each month?
Your variable expense are those other items. And Ridgely, what I look at with that is, you basically have about 50% of your income that's going to go to fixed. You're going to have roughly about another third or 30% that's going to be variable. And what a variable expenses is: clothing, food, entertainment, those things that you do each and every month that takes income to be able to do those things that you need, but they don't have the same expense each and every month.
So given the fixed expenses, given our variable expenses, can you share with us the best way to establish a realistic budget?
Establishing a budget is quite simply discipline, and it's a process, but it's not hard. It's more about being dedicated and focused on doing that. You sit down and you put a budget together and you lay out, here is my net income. This is what I'm bringing home each and every month. And there's a dollar amount to that. Then we talked about your fixed expenses, my housing, my transportation, my insurance, those items that are every month that are regular. That'll lead you into your variable expense, which once you go into your variable expense are those items that you can more control. Variable expenses, if you don't have the income that month and you've had unexpected costs, then you can modify those variable expenses, probably not eliminate, but modify. And so you put a certain amount of money out of that for my variable expenses. And then lastly, there's going to be a percentage of your income that we're going to talk about later which is saving and investing. And you're going to want a portion of that money to go to savings and investing. And let's back up just a second and kind of talk about something that's simple to get started. 50% fixed, 30% variable, 20% savings and investing. And that's a good way to put those three categories together. And then under those categories, start filling in the blanks, Ridgely, of here's my fixed, here's my variable, here's my savings, and how you're going to do that short-term versus long-term.
That makes complete sense. 50% fixed, 30% variable, 20% saving and investing. And we will be talking about that as we move forward in the series. Thank you very much, John, for this valuable information. Stay tuned, everyone, for part 2 of our financial literacy series, where we will focus on best practices for the use of credit and borrowing facilities. Very important topics for all of us. John, again, thank you so much.
Thank you.